This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
Now we're going to look at supply curves in addition to demand curves. So what we've got here is the demand curve we've kind of seen and loved so far. At a high price, the demand is fairly low. At a low price, the demand is fairly high. From the producer's point of view, this is what the supply curve is looking at here. If the price that the goods will sell at is relatively low, then relatively low volume is going to be produced because there's not much profit in it really. But as the price gets high, then we'll increase our volumes, more people will be brought into the market because you see the possibility of making quite good profits. Now what happens when both of these curves are brought together? Let's start off first with a fairly low price. So here we have a fairly low price, and at a fairly low price there's quite a high demand. So this is on the demand curve here. So let's say there's 1,000 units demanded, but at this low price there's maybe only, let's say 200, which is produced. So there's demand for 1,000, there is only this lot of 200 available. I think you can see what's going to happen. People will be clamoring for goods. There aren't enough goods. It's going to drive the price up. And as the price goes up, we're going to be moving along this line here. So price goes up, the quantity demanded falls away. And as the price goes up, we're going to be moving along this line here. As the price goes up, more and more suppliers are attracted into the market to produce. The quantity supplied will go up. And where they're going to stop moving towards each other is what's called this equilibrium point here. Let's say it's at, 700. And this is a market price. So demand and supply are kind of automatically regulated to match each other through what's called a price mechanism. Okay, so demand and supply will equal each other at a particular price, where suppliers are willing to produce just the right enough, just the right quantity, that at a particular price, and that at that price the buyers will just be prepared to buy that. Similarly, let me just get first rid of some of these things here. Similarly, if we'd started off with a relatively high selling price. So here we have a high selling price here. I would see maybe demand is about 200. Quite a low demand at a high selling price. This is the demand going down here. But maybe the number which are actually produced is really quite high, let's say 1,000. So we have excess supply, 1,000 produced, 200 demanded. These poor old producers can't shift their goods at this high selling price. So what's going to happen is they will begin to reduce the price of the goods. As they produce goods at a lower price, fewer people will want to produce as many goods at that price. It becomes a less profitable business to be in. So the supply will fall. But as you reduce the price, people want to buy more, so the demand will rise. We will be kind of down this way here. And again, we're going to end up at this perfect equilibrium point. And this market mechanism, as it's called, is the normal way in which you balance supply and demand. Price moving up or price moving down, increasing or decreasing supply and demand until they match perfectly, is the way most goods in most economies are managed. Let's see what will shift demand curves right and left, or particularly right, and similarly with supply curves. So here we have, we can look at this here. We're basically saying that a given quantity was said, instead of demanding that given quantity at a low price, for the same quantity, we're having a much higher price. Will sustain that quantity. The goods, for some reason, are more desirable. Okay, so a given price, more are demanded. Or if what you prefer is, you can say that for a given price, more is going to be demanded. So we're talking either the same quantity will be demanded at a higher price, or at the same price, more are going to be demanded. But one way or another, the goods for some reason become more desirable. Yeah. What's going to do this? Well, potentially a rise of income, provided they're not inferior goods. So a rise in income will, by and large, say you are going to shift more goods at the same price because people can afford more of them. If it's an inferior good, remember, they would trade out of them. They would trade into better goods as their income increased. A rise in the price of substitutes. Well, I don't change my price, but my substitutes, the substitutes go up in price. People abandon the substitutes, they come to me. So for the same price, I've got far more customers. A rise in the expected value, expected price of a product. If I expect the price to go up by 50% in 1 year, I'll buy lots now. There'll be a much higher demand as people protect themselves against the rise in price. They hoard the goods, really. Reduction in the price of complements. Again, we've seen that. If the government was suddenly to take the tax of cars, so that the selling price of cars went down, the volume of cars sold would go up, there'll be a greater demand for petrol, even though the price hadn't changed. Change in tastes. Something goes into fashion, there's greater demand for it at a similar price. Something goes out of fashion, you won't be able to sell anything if you keep the price there. And finally, a population increase. If, let's say, the export rules changed, instead of just selling to a population of maybe 5 million in your country, you can sell to 5 million people in your country and 5 million people in a second country, then essentially you've got twice the demand for the same price. Rightward shift in the supply curve here, fall in cost of production. So if there's a fall in cost of production, it means you can make a better profit for the same price. So if you can make a better profit for the same price, you want to make more of them. So what we're saying here is the same selling price, producers are essentially willing to make a bigger quantity. Technology changes. Technology changes is essentially provoking a fall in the cost of production. So improved technology means you can make goods at a lower cost. If you sell them at the same price, you're going to get a better profit. You're going to stimulate people to want to make those goods, make more of those goods. Improved efficiency, and again another example of the fall in cost of production. Subsidies. Subsidies is money given to you by the government, and to all intents and purposes, if the government says, right, I will pay you $10 for every unit you make, if making the units yourself costs you 100, and then the government gives you 10, effectively the units are only costing you 90. So it's as good as a fall in cost of production. And similarly, lower taxes allow you to retain more of the profits you make. So if there are lower taxes, you see more opportunities for making profits at the same selling price, because when you keep more of those profits, then it's going to stimulate the production. And we're moving stuff to the right. So for the same price, you're going to be selling a larger quantity, or going to be rather manufacturing a larger quantity of the goods. Or alternatively, of course, you're willing to sell the same quantity even if the selling price reduces. So the selling price is reduced, but because of maybe a fall in cost of production or technology changes, even though the selling price is even though the selling price is reducing there, you are prepared to make the same quantity because these efficiencies you've got in production allow you to make good profits still, even at a lower price. We can have demands, the demand and the supply curve kind of shifting together here. Let's just see what happens in these arrows. The first one here, we have a change in the demand curve. The demand curve is moving rightwards here. This means that the equilibrium point had been here. And what we're saying is essentially that in a way we're shifting. If we kept the same price there, then the amount demanded would be there. But now we have a disequilibrium. The amount demanded is here, but this producer is still on the same supply curve as there. We now have excess demand. Demand is grown, maybe because of an advertising campaign, maybe because the goods have become very fashionable. And what happens when you have excess demand? There is a clamour for the goods and here, and we'll move back up here. The price of the goods begins to rise because of this excess demand, and this increase in demand, an increase in price is going to increase the supply, and again we'll come back to equilibrium. So if you have an advertising campaign selling your goods, or your goods, let's say, become very, very fashionable, what will tend to happen is demand goes up. This will push up the price. Because the price has been pushed up, the supply is pushed up as well, and you come back to rest somewhere. Similarly, if we have a change in the supply curve, what we're saying here is more can be produced for the same price, more can be profitably produced for the same price. So this was our initial equilibrium point here, where demand and supply cut each other. And now what we're saying is, gosh, we are willing to produce some more for the same price there. The same, I beg pardon, we want to go from this supply curve to this supply curve. Let's get rid of that one if I can, without messing it all up. Right. Get rid of that. So here we have our current equilibrium point here. Okay. A technology change comes about, and this means for the same selling price, the producer is willing to produce many more goods. Okay. So now what we have is we have at this price, the producer is willing to sell this volume or produce this volume, but of course the poor old buyer doesn't want to buy anymore because the price is still quite high. So what the producer has to do at this higher volume, to shift these goods at the higher volume, they have to reduce the selling price. And so what we're going to be doing is we're going to be reducing the selling price. We're going to be increasing the demand until we come to an equilibrium point which is there. So if there's a change in technology, what will tend to happen, which cheapens the price of the goods, the cost of manufacturing goods, this change of technology will tend to mean that more goods are going to be produced by the producer, but to shift more goods, the selling price to the consumer will fall slightly. So we end up moving from here to here. Instead of a low quantity of goods at a high price, we've moved to a higher quantity of goods at a lower price. But again, everyone's kind of happy. We have an equilibrium point within that. The final thing that we really need to look at on curves are cost curves. And we need to look at this fairly kind of carefully, not really but not too deeply, I don't think, here. So basically there are two sorts of costs we need to worry about. There is fixed costs and there's going to be variable costs. So fixed costs are costs which don't vary with output. So it'd be stuff like the factory rent is a fixed cost. Some sorts of salaries are fixed costs, administrative salaries are fixed costs, and so on. Usually depreciation is a fixed cost because it's just 20% of the cost of the non-current asset, and so on. So this line here, this yellow line here, is the fixed costs. And what you do with fixed costs is the costs are fixed. As you increase the production, you are essentially spreading those fixed costs more thinly. The fixed cost per unit will be fixed cost divided by the number of units produced. You're making better use of the factory and so on. So the fixed cost per unit will start fairly high and will move down here, down, a reducing cost per unit. Second curve we look at is the average variable cost, the variable cost per unit, if you like. And the normal assumptions in looking at these curves here, and this is this red one here, this AC one here, this is the average variable cost here. So at low volumes, and variable costs is really saying the more units you produce, the more the total variable costs are going to be. So the more units you produce, the more material you have to buy. The more units you produce, the more labour you have to pay if it's an hourly paid labour. So what most of the kind of assumptions behind this say is at quite low volumes, you're not going to be buying very much material. You're not going to get very good discounts on that material and so on. You're a little bit inefficient, perhaps. But what happens is we go down here, we are beginning to get what could be called, I suppose, economies of scale. So we are saying that as we produce more units, as the quantity produced increases, we will be able to maybe get very good discounts on our material. We'll be able to make maybe more efficient use of labour. So labour won't be sitting around idle waiting for production. We'll be keeping all of the people busy all the time and so on. And so the variable costs begin to decrease. The variable cost per unit, rather, begins to decrease. But then the economists recognize something called the law of diminishing returns here, that things are getting better and better and better and better and more efficient. Now we have everybody fully employed. We've got a really good discount, if you like, on our material. But then if we want to get more labour, maybe we have to start running the machines longer or harder. And quite often when you run a machine more quickly, it becomes less efficient. Right, like driving a car at 30 kilometers an hour compared to 80 kilometers per hour, the petrol consumption per kilometer goes up. Similarly, our labour, we're going to have to pay them overtime, perhaps. Similarly, material, we've bought all the cheap material around, we're kind of cornering the market now. We demand more and more material as our demand increases, and the unit cost of material begins to go up. So what we get eventually here is the average variable cost increasing. So we go down kind of through a minimum, and then the average variable cost begins to increase. It is worth producing in the short run, provided the price you can get for goods is more than the current variable cost. So if it costs you $5 of material and labor and so on to make something, and you can manage to sell that for 6, you're going to be making what's called a positive contribution. The cost of making one more unit, we're not talking about the average fixed costs, they're kind of fixed, but if the average variable cost per unit is 5 and you can sell these units for 6, you may as well do it. That extra £1 margin you're making there is going to help you pay your rent and so on. The total cost together, this green one here, is reckoned to be kind of the sum of the average fixed cost and the average variable cost. We have got the average total cost as the sum of those two. And the final element is the marginal cost, which we have here. The marginal cost is the additional cost for each extra unit which is being produced. And the marginal cost line will go through the minimum point of the average variable cost line and the minimum point of the average total cost line. If you have your variable cost, if the average variable cost is falling, it really means you must be, when you make another unit, you must be mixing in a unit which is cheaper than the average so far. So your average variable cost here might be 6. And if you're still going down here, the cost of making one more unit must be 5. So the marginal cost, the cost of producing one more unit, if it is below the prevailing average cost, your average cost keeps going down. The marginal cost therefore goes through the minimum point, because once the marginal cost rises, becomes quite large, every additional unit you make is in a way pulling up the average cost. So the marginal cost is above the average variable cost. You must be pulling up the average variable cost. So both here and here, the marginal cost line is going to cut the average variable cost line and the average cost line at the same points. And finally, types of competition. 4 types of competition to recognize. Perfect competition. Perfect competition is where you have very many small buyers and sellers. No one of them is large enough to influence the market or influence the price. One of them could double output, but that's not going to make any significant difference to the overall volume which is available. These people essentially have to charge the market price. If you're in a perfect market, lots and lots of competitors selling essentially the same goods and so on, if you were to drop your price, there's no logical reason for that, because you can sell everything you can make at this market price. If you were to raise your price, no one would come to you. Your market price of 10, you say, I'm going to put my price up to 12. Why would anyone buy from you at 12 if there's lots and lots of other people who will happily sell to you at 10? So everyone's kind of trapped by this market price, this equilibrium price, as it's called. A monopoly, there's only one supplier, really. And if you're only one supplier, you can set whatever price you like. But remember, you're facing all of the demand curve. You can set whatever price you like, but you're probably going to be facing the downward sloping demand curve. If you set a ridiculously high price, then demand might be 0. And at some point you could set you could almost be giving the stuff away, and there'd be a limit on how many goods you could actually make, you could actually give away. So the monopolists can sell goods, or they can set their selling price wherever they want, But remember, that doesn't guarantee, it gives them freedom, but it doesn't guarantee any profit whatsoever. A monopolist might be a monopoly supplier of goods nobody wants, or goods nobody wants at the price they are charging. But at least they have a lot of kind of freedom, provided they're on the demand curve, to decide whether to charge a particular price for a particular volume. And with a bit of luck, they'll be able to manipulate their price and their demand so they can maximize maybe profit. The perfect market player can't manipulate price to really change their profit. An oligopoly is where you have a few large suppliers, something like the petrol companies, the oil companies. So there we maybe have 4 large oil companies. They have roughly 25% of the market there. And they kind of watch each other. If, let's say, Shell were to increase the price of a litre of petrol, the other ones just sit tight. People will now start driving past the Shell garage, because that's expensive, and they will go into the Texaco or the BP garage or whatever it's going to be, and buy the cheaper price. So by raising your price, the other ones don't follow, you're going to lose revenue. So that's a bit of a dangerous gamble. If Shell were to cut its price, then people begin calling into the Shell garage in preference. The other people have to follow, really, because they will be losing market share if they don't follow down the reduction in price. The danger for these garages then is all the 4 large oil companies may end up reducing price and not substantially increasing the volume they sell. So you get a kind of slightly uncomfortable situation. They all kind of watch each other, are making kind of judgments about what they should do and what the others might do, and so on. And finally, we have monopolistic competition. This sounds almost a contradiction in terms. We have monopoly, which implies there is no competition, you're the only supplier, we're talking about competition. What it means is you are really competing on something other than just price. And a good example would be the car companies. So you take all the car companies, they all sell what I would call kind of family-sized cars, whether it's Ford, General Motors, Opel, whatever you want to call it, Nissan, Toyota. They're all selling cars, so they're all competing in that sense. And they all, but they are not just competing in price. Volkswagen, for example, would say, well, if you buy one of our cars, then you're not just buying a car, you're buying kind of German engineering and so on. Mercedes might say, when you buy our car, even though it's roughly the same size as the Volkswagen or the Nissan or something, you're not just buying a car, you're buying a Mercedes, and all the ideas of kind of quality and luxury that might be going with that. If you buy a Nissan, they might be saying, right, you're buying a car, but you're buying something which has got maybe no particular airs and graces, got a very reliable, good value type of car, and so on there. And so they're not, say, you can have a range of prices for essentially very similar products. But the products will all kind of end up doing the same thing. But they've got different kind of associations with them. The brand says different things, different qualities, different technology, different feeling going with these items. And it's sometimes called non-price competition, that you're competing in something other than price.